We have some breaking news. Hedge fund investor Bill Ackman has gone short U.S. long-term Treasury. Let's take a look at the tweet here, just pushed earlier this morning, on how U.S. long-term rates have remained too low in light of structural changes that are likely to lead to higher levels of inflation. So his thesis is that rates are too low and that they're going to go up because of inflation pressure, supply demand, too much debt being issued by the US government, and other countries like China looking to decouple financially from the US. So he thinks that rates are too low, so they're going to go up. So remember, rates go up, so therefore prices come down. So if you think rates are going to go up, then you short the bonds because the value of those bonds are going to come down. This is relevant to some of my tutoring clients where we've been talking about the time value of money. So I want to tie that together. And in our sessions, we've been talking about how the cash flows for a business proposition, whether that be a bond or a company, they get discounted back to present value using a discount rate. And that discount rate can be further decomposed to its underlying constituents, such as the maturity premium, liquidity premium, default premium, the inflation premium, and the real rate of return. If Bill Ackman is correct that rates are going to go up, this has major implications for almost every financial instrument because this hits at the bedrock of everybody's discount rate. Again, everybody is discounting all cash flows back to today using this discount rate. So what happens when this goes up? When this goes up, this discount rate goes up. When this discount rate goes up, that means that the present value of your cash flows, for all the cash flows that you're forecasting, they all go down. Well, Bill is saying that we're going to have higher inflation, right? So that's the inflation premium right here. So let's move that up. It's going to be, I think he said it's going to be up to 4%, maintain it above 4%. Let's see this. Okay, so long-term inflation instead of 2%. So we've been at 2% right now, and we can look at the tips for that. So we can compare 30-year Treasury yields for 4.24% to tips 1.93. And that's roughly 2%, and he's saying that's going to go to 3%. So let's go back to our worksheet and say that now, so this is 2% here, let's say 2% here. What does that do to our cash flows? All right, so we are at roughly $1,592.50 in this example. Let's move this to 4%. Okay, so now we've lost some there. So let's do that again. Okay, at 92, and let's do 4%, drops down roughly $50 or so, from 92 to 39, $50. You've lost $50 in your present value of the cash flows. Because again, this discount rate is made up of these underlying components, inflation being one core parts of this, also the real rate. And this discount rate is being used to discount back all of these cash flows here in years 1, 2, 3, 4 back to today. So when this goes up, then the present value of all these cash flows is going to go down. And so if Bill Ackman is correct, then you would expect to have downward pressure on all valuations of investments because everything is a function of being discounted back to today. I wanted to take a moment to tie in the material that we're learning in the CFA content to what we're seeing in the real world. I hope that helps. I'll link to the tweet in the description below, and you can also check out this Bloomberg article as well for a little bit more information. All right, talk soon. Bye.